Let's talk about minimum set-asides and additional restrictions. So your minimum set-asides are a project rule, and there's two choices. At least 20% of the units must be set aside for households that are at least 50% or less income AMI, or 40% of the units must be set aside for households, tenants whose income is 60% or less AMI, area median income. This one is the most common in Utah. Again, this is a project rule. Now, each building is considered its own project unless at the time of application the owner elects the buildings to be part of a multiple building project. This is done on Form 8609, line 8B. Now, if no election was made on Form 8609, then it's like the owner said, yeah, each building is its own project. If this is done, then the minimum set aside must be met per building because each building is considered its own project. If the owner elected that each building is part of a multiple building project, then this is on the project as a whole. So the minimum set-aside election determines both the minimum number of tax credit units at the project and also the federal income limits that are used on the project for eligibility, for tenant eligibility. The income limits must be used and maintained throughout the life of the project. So let's talk a little bit about additional restrictions. Some of you have additional restrictions, not just the 50 or 60% AMIs out there. Owners at the time of application may put in for additional, more stringent AMIs than the federal 50 or 60%. These are considered additional restrictions, additional rent and income restrictions, and are agreed to by the state and the owner, and are spelled out in the land use restriction agreement, and also must be followed for the life of the project. And if the owner ever does sell the project, these restrictions follow the project.